Welcome, my name is Monica and I'm your host. Today the purpose of our video is to present you the winning strategy for 2026 on macro, equities and crypto. Let's go together. Chapter 1, Financial Markets. We are at the beginning of the week 20th of October 2025. After a strong rally during the summer, investors start asking questions themselves about the sustainability of the stock rally, particularly in the AI theme, artificial intelligence. President Donald Trump has also shaken markets last week with threats on high tariffs on China. Rumors about a possible bankruptcy of two regional banks in the US have also penalized the banking sector as well as cryptos during the weekend of 11th October. As a consolation, this was a good opportunity to start investing for our two portfolios. However, there was a positive tone last Friday on the 17th with financial results published by the big US banks. Financial markets have rebounded. Concerning the US dollar, it has made a reversal against euros and other currencies, stopping a bit its weakness. Remember to always have a look at currencies. They often anticipate trends. Usually a weak US dollar is beneficiary for emerging markets. It explains a large part of the rally in emerging markets in 2025. What to do? Stick to our strategy, investing regularly in order to smooth our entry price. Let's have a look to valuations on main markets. US markets seem to be at the top of their relative dominance. They are more and more expensive compared to the rest of the world. Look at the price-earning ratio, PER, an indicator of valuation, and expected earnings for the emerging markets and the US index SP500. The US SP500 index has a price-earning ratio of 22.5 with earnings around 11%, while the emerging markets have a price-earning ratio of 13 with earnings around 17%. Those data are for 1 year rolling from now. The risk-reward is clearly in favor of emerging markets.
Welcome back. My name is Edward, and I have the pleasure to talk about our portfolios. As you can imagine, it will not be possible to anticipate any speech from the President Donald Trump, although they can strongly influence financial markets. We don't make politics, we are investors. President Trump has a strategy to negotiate with the Chinese. He plays his cards and seems sometimes indifferent about Wall Street. This is something to have in mind for our investments. So we integrate potential bad news with a prudent asset allocation. Remember 70% tiger and 30% rabbit, 70% invested in equities, cryptos, or ETF, and 30% cash. Our Buddha animals will really help us to manage volatility. Portfolio 1, 70% equities, 30% cash. We prefer emerging equities to developed equities. We stick to our strategy, investing in emerging markets ETF, but this week we start investing in direct stocks. We have chosen to start a position in HDFC, a large Indian bank. Why India first? This country is one of the most promising inside emerging markets, but it is always one of the most expensive countries in the EM universe. Why? Because it has a lot of diversified sectors and companies. If you think Taiwan is completely connected to tech and semiconductors, China has a lot of banks and consumption stocks. South American equities are often linked to commodities or renewable energies. India has the most important range of companies with a broad universe in terms of sectors. You find companies involved in technology, commodities, consumer, finance. This explains a premium versus other EM countries. India is always a bit expensive but has corrected over 1 year. We think we can enter this market. We have chosen HDFC, that is a leading bank in India, with an attractive valuation. Please stay tuned and have a look at Chapter 3 Ideas and Themes. We will show you how the Mickle-Porter analysis applies to HDFC. Our trades for Portfolio 1 are, this week investment €50, in which €20 in ETF EM, €15 in HDFC, €15 in cash. Portfolio 2, 70% cryptos, 30% cash. We started in episode 1 to invest in Bitcoin and Ethereum. We prefer definitely Ethereum versus BTC. ETH is benefiting from tokenization. It is one of the most secured blockchains able to manage large transactions, and it has improved considerably its scalability. Finally, thanks to tech improvements and several upgrades, it is much less expensive to use than during previous cycles. Transaction fees have dramatically decreased. Our target in 3 to 5 years is at least 10,000 USD for ETH and possibly higher. today around 4,000 USD. We will maybe pick up some altcoins later, but we concentrate our efforts today on Ethereum. So today we invest 70% in Ethereum and 30% in cash. Our trades for portfolio 2 are investment, 50 USD, 35 USD in ETH, and 15 USD cash. Trades from this week and last week are written in the description of the video. We remind you our actual positioning and details of our portfolios. We are starting the journey with you on global financial markets. This is very exciting. We remind also we try to make regular investments for our children, but it does not prevent to be active and dynamic. This is why this second video is closer from the previous episode, because we see currently some opportunities in price action of several assets, notably for Ethereum. Concerning technical analysis, there was a risk last week the Dow Jones made a breach to its bull trend. We need to wait for a confirmation, but it would be, of course, very negative. Similarly, on cryptos, an important correction has also started. Several analysts in cryptos like to remind us the 4 years cycle that could be at his end, meaning a possible correction of more than 50% for the BTC. Rather than taking immediate decisions, we wait a bit to analyze those trends. It is always difficult to anticipate. So far, our prudent allocation is warranted. One last comment. We think, however, some alts will not come back after their huge drawdown last week. We will elaborate on another video. We prefer focusing on big cryptos that will survive for sure. So today this is ETH. Concerning the setup, we still use Revolut for equities and ETF, and Binance for cryptos, without any affiliation. We are looking at possibilities to reduce fees by using other exchanges, of course. Don't hesitate to advise us. Depending on market moves, we will intervene if necessary and make a video immediately. I keep you posted. Bye.
Chapter 3. Ideas and Themes. Hello, this is Monica presenting a monkey strategy again. I am very happy to show you today an analysis very useful to analyze a company. This analysis is called Michael-Porter analysis on the 5 competitive forces. Porter's framework helps evaluate industry attractiveness and competitive pressure by looking beyond direct competitors to the broader ecosystem of suppliers, buyers, new entrants, and substitutes. 1. Competitive rivalry, industry competition. This force examines the intensity of competition among existing players in the market. High rivalry usually means lower profitability because companies are forced to compete on price, innovation, or marketing. Factors: number of competitors, market growth rate, differentiation, and exit barriers. 2. Threat of new entrants. This evaluates how easy or difficult it is for new competitors to enter the industry. High entry barriers, capital requirements, regulations, economies of scale, strong brands, protect incumbents. Low barriers make the market attractive to newcomers, increasing competition. 3. Bargaining power of suppliers. Suppliers can influence profitability by raising prices or reducing quality. If there are few suppliers or unique resources, their power is strong. If suppliers are numerous or easily replaceable, their power is weak. 4. Bargaining power of buyers. Customers. Customers can pressure businesses by demanding lower prices, higher quality, or better service. Strong buyer power exists when customers are concentrated, products are standardized, or switching costs are low. Weak buyer power exists when customers are fragmented and depend on the seller. 5. Threat of substitutes. This force looks at the risk of products or services outside the industry replacing what the industry offers. High threat. When substitutes are cheaper, better performing, or easily accessible. Low threat, when substitutes are expensive, less effective, or rare. Read this carefully, and we will see together how it applies to our future stocks selected in our portfolio. Believe me, this is absolutely critical to have each time a look at Michael-Porter analysis when you pick up stocks in your portfolio. To help you, in the video description, we have indicated the Porter analysis made for an Indian stock we particularly like, the Indian bank HDFC. Remember last time we saw an analysis on the growth inflation quadrant that was favorable to India and emerging markets.
Hello, my name is Maya and I am your host. Here's Porter's 5 forces analysis applied to HDFC Bank, India. 1. We start with competitive rivalry, industry competition. It is high. Indian banking is indeed very competitive. HDFC Bank competes with ICICI Bank, Axis Bank, Kotak Mahindra Bank, and State Bank of India. HDFC Bank competes also with fintechs, Paytm, PhonePe, Razorpay, that create disrupting payments and lending, adding to rivalry. Pressure on interest margins is also strong, especially in corporate lending. Conclusion, not so favorable. I have to say this is a challenging start. 2. Threat of new entrants. It is moderate to low. Entry barriers are high due to regulation by the Reserve Bank of India, RBI. There are also high capital requirements and trust or reputation factors. Digital-only banks and fintechs can enter more easily, but scaling to HDFC Bank's level, notably branch network, customer trust, is very difficult. Conclusion. This is positive. Then 3. Bargaining power of suppliers. This is moderate. In banking, suppliers are depositors, employees, and capital providers. Depositors in India are fragmented, so individual supplier power is low. However, to attract deposits, banks compete on interest rates, giving depositors some indirect power. Finally, talent, skilled bankers, tech experts, is also a critical supplier group with growing influence. Conclusion, this is positive. 4. Bargaining power of buyers or customers. It is high. Customers, retail, SMEs, corporates have many choices among banks and fintechs. Switching costs are relatively low thanks to digital platforms and UPI, Unified Payments Interface. Large corporate clients have especially strong bargaining power because they negotiate directly on rates. Conclusion, let's say neutral. Then 5. Threat of substitutes. It is moderate and rising. UPI payments reduce reliance on traditional banking for transactions. NBFCs, meaning non-banking financial companies, and fintechs provide loans, investment products, and insurance alternatives. For international money transfers, fintechs and crypto are substitutes. Conclusion, let's say neutral. Of course, the Porter analysis is always difficult to appreciate correctly. There are a lot of factors and information. You need to reassess quite often your investment thesis. It is quite rare to have a very affirmative opinion, but at least it raises often good questions for your investment. Conclusion. HDFC Bank operates in an environment of intense rivalry, strong customer power, and rising substitutes. Barriers to entry protect it from large new banks, but fintech disruption erodes some of its advantage. Maintaining growth will depend on digital innovation, cross-selling financial services, and deposit mobilization. However, management execution has been remarkable so far, and HDFC is really an innovative company, something to keep in mind. We will keep you posted, of course, if there were any material change in our analysis. But overall, HDFC Bank seems able to be one of the leading competitors among Indian banks. Hope to see you soon. Don't forget to subscribe.